Today I'd like to talk about the crisis that has been discussed and disclosed today relative to Silicon Valley Bank. One of the interesting things about Silicon Valley Bank, in addition to being the bank of tech startups in Silicon Valley, it also was the bank to a lot of middle market companies. And I think what most people don't realize is that companies such as Etsy, who send payments to small retailers and others who use their services, couldn't get a hold of their cash on last Friday. And this was going to impair payments to their customers, as well as impacting payrolls of a lot of middle market companies. This was also true for growers in the wine industry. There were many wineries who banked at Silicon Valley Bank and were faced with a payless holiday. And so with the government stepping in to give some assurance that not only were customers who put deposits on up to the FDIC limit, $250,000, but they were going to guarantee everything above that. And the reason they do that is really to provide stability in the banking community, because everybody who had more than $250,000 was worried that their deposits were not insured. And really, this isn't a big issue as long as there's liquidity in the marketplace. And when there's not liquidity in the marketplace, companies as big as Amazon and General Motors would have difficulty transacting if they couldn't process payments on a daily basis. So having a vibrant currency exchange is essential to commerce in the U.S., and it was a good thing that the government stepped in. But it raises some additional questions. First off, if you look at the banks in total, they hold almost $700 billion of treasuries, which have been devalued by the increasing rate of those treasuries and, are in impairment. And I don't mean just $700 billion of holdings, it's $700 billion of unrealized losses. The FDIC in their reserve holds about $128 billion. Barely the size of Silicon Valley Bank. And so you can imagine if local, regional, and even some of the large banks started pushing on FDIC insurance for depositors, that money wouldn't go real far. So where does the FDIC get their money from? They get it from other banks in terms of insurance that each bank pays in order to create a fund for these kind of losses and provide stability into the banking market. And so you can appreciate if you're only holding about $128 billion, you've got almost $700 billion of losses in the banking system impacting banks' tier one capital, that you could have a lot of distress very quickly if there's not some semblance of order into the marketplace. The issue this raises, though, because of the small amount of reserves for the FDIC and the size of the banking industry, is the U.S. taxpayer now going to be responsible for bailing out banks when they have financial difficulty? Because clearly the government isn't of sufficient size to bail this out. And is this really where the taxpayer money should be? And so my guess is you're going to see a lot more regulation near term and restrictions, which isn't going to make it easy for commercial banking. Already you have what I call shadow bankers, who are really people who provide lending opportunities but don't take deposits, who are not under the purview of federal regulation the way commercial banks are. And they're going to be eating more of the share of the commercial banks as this restriction gets put into place. So it'll be an interesting summer. I think there's still a lot to be worked out. What was interesting is Mr. Frank, the author of the Dodd-Frank bill, happened to sit on the board of one of the banks who had financial difficulty last week. So nobody's immune from this. And the oversight and regulation, I think, will continue to be there until this gets sorted out. So buckle up and stay liquid.